All right, everyone. Welcome back to the Multifamily Wealth Podcast. With me today is Jorge Abreu. What's going on, man?
I'm doing good, man. How you doing?
I'm doing fantastic. Really looking forward to our conversation. I've been passively seeing everything you've been doing on LinkedIn. So, good job on there, right? Staying top of mind with folks on the fringe of your network. So that's perfect. Let's just jump into your background here, and why don't you share with the listeners maybe what you were doing prior to real estate, what your business looks like now and what you're up to.
Yeah, for sure. So, prior to real estate, I was going to school to be an electrical engineer. Towards my senior year, I sort of realized that I didn't want to be an engineer. I just, I like meeting people. I like getting out there, and the engineer side kind of seemed like I was going to be more stuck behind a desk. So I started doing some research and looking at, at the same time, I had this desire to build a good amount of wealth and to be able to provide for my future family at that point. So I started doing research and seeing, highly successful individuals, how did they gain their wealth, or how did they really take it to the next level? And a lot of that led back to real estate investing. So I started digging pretty deep into real estate. Meanwhile, I graduated with my degree. I went to go work for UPS in their engineering department. While doing that, I was able to start investing in single family, and started doing deals consistently between wholesales, fix and flips. Wasn't really doing many holds at that time. Enough to the point where I quit my W-2 and I started doing real estate full time. 2008 came, the whole crash happened, and before that, I was born and raised in South Florida. So when that happened, South Florida was hit really hard. It was ridiculous. Like, the pricing was going down every single day on houses, and I needed to make a decision whether I was gonna pretty much go back to corporate America, or I don't know. But I started looking around, and had a buddy of mine that had moved to Dallas a couple years before that, and came to visit him, and it was like night and day over here in Dallas compared to over there. Decided to move, and then really started ramping up. Started doing a little more holds at that point. Did some smaller multifamily, and then as the market started picking up, really started to pick up fix and flips. And that's when I decided to also open a construction company to help me scale that fix and flip. I was probably doing about 45 to 50 a year. And then about almost 4 years ago now, I kind of stepped back, and it almost felt like I woke up, and I was in this constant grind for, at that point, it was maybe 10 years. And I took a breather, and I looked, and I saw what I had built, and I wasn't happy. I hadn't really built what I set out to build, which was generational wealth. Everything at that point was pretty transactional. Didn't have a lot of passive income or just cash flow in general. Everything was on to the next, one deal after the other. And that's when I started looking more into multifamily. Actually, on the construction side, I had a couple clients that were syndicators, and I was doing some of their renovation work on their multifamily properties, and started asking them a little bit more. And that's when I really realized that you can do a syndication. And before that, I thought you had to have all this money to buy these apartments, and you had to have millions. And that really opened up my eyes. So I started digging more into multifamily. I ended up getting a coach, and at first I was doing both multifamily and single family. And at one point I realized that my passion was in multifamily, and I just stopped doing single family altogether and started going after multifamily. Now I'm about a little bit over 1,700 units, and looking to get to 10,000 units in the next 2 years or so.
Well, it's a great story. And it's a lot of single family deals, before getting to multifamily.
Yeah.
And I was going to ask you, what was the reason that you decided to change your model, but you answered it really, which is that, that wealth or that income is transactional, right? It's in one day and out the next. But there's no cash flow there, and it's really a job, right? You're doing your work and getting paid once rather than getting paid in perpetuity. I want to talk about your construction business though, because I think this is a really unique, I think it's unique to you in a lot of ways, or at least a lot of the folks that I've had on the show and then I've talked to. The construction management side of the real estate investing business is probably what syndicators and real estate investors struggle with the most, at least in my experience, especially in large scale multifamily where you're repositioning the building and renovating units. You're conducting a business plan that typically has construction as a piece of it and some kind of renovation aspect. Can you talk about the benefits of having construction vertically integrated, and maybe if that's something that an existing investor should consider doing? And I'll ask some questions after that, but maybe what are some of the benefits of having that in-house?
Yeah, I can definitely start with the benefits. So, I mean, the benefits, well, I'll tell you more of the issues I ran into first. So
Okay.
I wanted to scale the single family. I didn't want to just do, a couple flips at a time. And the issue I kept running into was just finding good contractors, ones that I can trust and that can get things done on time, get them done right, good quality, still inexpensive or not as expensive. So that was where the idea came from. And I did have some experience with being in two of my uncles own construction companies, and I worked with them early on. So I felt like I had the skill set to get it done. Then the main benefit is you have more control. You have more control. You can set your own systems and processes of how things get done. You can make sure things don't get missed. You can, if you don't hit your deadlines, it's on you. So a lot more confidence when I go into a deal, or if I'm evaluating a deal, I have more confidence in the ability to get the business plan completed in a timely manner.
Yeah, that makes a lot of sense, and that's what most investors I know who have started their own construction business or some are hired guys to do their work in-house. That's typically what they say is, maybe there's cost savings, like that's a piece of it, but the main goal is the control and being able to direct, folks to different projects at different times and keeping the control of that, because, it minimizes the time to get a lot of these projects done, and time is money in real estate. So that directly translates to cost savings. Let's pretend we got an investor listening to this who's got, maybe a couple hundred units or something like that, or maybe they're flipping 50 homes a year like you were, and they're considering bringing this in-house. What are some things that they should think about if they do decide to do that?
It's a business within itself. I mean, it's not easy. It's been a struggle at times. It's taken a lot of work, a lot of my time. So I would say don't just do it to do it. You've got to be passionate about it as well. So, I mean, my favorite part of acquiring a property is the construction part of it and the transforming that property. I just really enjoy it, and I'm passionate about it. And I literally took the time to learn everything about construction. So don't just think it's going to be something you just do. I mean, you're going to have to devote a lot of time towards it, and it's not easy.
Yeah, exactly. I mean, it is a business, right? I mean, you're starting another business is really what it is. It's not, you can't half-ass it. I mean, and that goes for like management too, or or anything else that you bring in house. Like, it's not like you just hire a property manager and it's the same as having third-party management. Like, now you have a management business that you need to manage and run, and you have to hire people, you have to fire people, you have to manage them on a day-to-day basis. So sure, yeah, I mean, you do save some money, you do increase your control over your projects, but there's an opportunity cost to that in a way. So you got the construction business humming along, you're flipping houses, you're wholesaling houses, you're doing some multifamily deals, then you realize you want to do multifamily more, or just focus more on multifamily. What were some of the challenges you faced early on, maybe as it relates to getting that first deal done, or raising the money for some of those earlier deals? Let's talk about that process.
I mean, finding a deal, it was a hot market. It was, especially here in Dallas, is where I started looking first, since I live here. I think that's kind of what everybody does, unless you live in California or something like that.
Or New York, and that's just
Right.
not happening.
So I don't even know how many deals I underwrote, and I know it was over 100 easily, and nothing was penciling out. I couldn't put it past me to pay retail. I've always trained myself, and my coaches have always taught me the money's made in the buy. If you're going to buy something retail, sure, you can maybe still add some value to it, but I mean, you're banking on the price going up, and it's just not a good buy. So I started looking outside, some sub-markets of Texas, and then eventually Oklahoma as well, and that's when I started having more success. Did finally get some stuff here in Dallas, but underwrote a lot of deals. That's what I can kind of.
Yeah, that's pretty much a constant with everyone that gets into the business, right? It's like you look at a million deals, and oftentimes it's not even and maybe you can speak to this. It's not even looking at deals more so to find deals to act on. It's just looking at deals to understand the market and understand the pricing, and to get a better sense of what you're actually looking for, especially early on. Yeah. So with a background in wholesaling and flipping, I would assume that you were doing some marketing to find those deals. And correct me if I'm wrong, but to do 40, 50 a year, I'm sure there's marketing involved to get to those numbers. So did you do any marketing on the large multifamily space, or did you mainly go through brokers to find those deals? And how did you kind of build your lead funnel to actually start looking at all these deals?
Yeah, I mean, at first we did. We brought over some of that marketing from the single family homes, which we realized not a lot of multifamily investors were doing. It seemed like most of them were just going straight to the brokers. So we scrubbed CoStar for owners in the areas that we had already pinpointed that we wanted to be in, and we would cold call as well as mail, do direct mail. We landed our first 2 deals doing that. It was from calling. Direct mail, we got some. Direct mail could have worked. I think we had to stay a little more consistent with it. We did get some leads, but it just didn't, nothing came from it. And then after the first couple deals, we just started, once you gain that traction and brokers start finding out that you can close, and we just started getting a lot of deal flow.
Yeah, from brokers.
From brokers, from guys that are starting out and wanting to do investments, and needing to co-GP with somebody.
Yeah, so there's a couple of things in there I want to touch on. One, I think cold calling is a strategy that is pretty effective when you get to that size. And from what I've heard from other investors, a little bit more effective than direct mail. And I'd love your take on this. I've heard from a lot of folks that do business in the 100+ unit multifamily space, where they're syndicating deals, and it's not everyone that says this, but a lot of folks that do that or do business in that space say this, where going direct to seller is almost like a waste of time. Like, the folks that own those properties are typically listing them with brokers or using a broker to sell them when they decide it's time to sell. Would you agree with that? Or would you say that that's probably just too blanket of a statement?
I would say that most are probably going to list with a broker, but if you get to them before they decide to list with a broker, why wouldn't they sell it to you?
Yeah, and I think your results prove that. It's one of those things where I feel like the folks that are saying that, right, have gotten deals through brokers and have deep broker relationships, and maybe they don't need to do that. But yeah, you're right. If you give somebody a price that they're looking for and it's off market, then there's no reason for them to take it to a broker, unless there's some other reason that they're doing so.
I'll tell you this, it's not fun cold calling. That's one of the things, it's something that not everybody's going to do. So yeah.
Yeah, exactly. And as it relates to maybe building relationships with brokers or other investors who are maybe looking to find deals and then bring them to someone who's got an established track record to help them close on it and raise the money. Do you have any tips for listeners, maybe as it relates to they're entering a new market and they're trying to develop these relationships with the brokers that do the majority of the business, or the investors that are looking to bring deals to the table? Because obviously that's the most important part, as I'm guessing you would agree with.
Yeah. Okay, so the broker part is the one thing brokers want to know the most, is that you're actually going to close. They get investors or buyers calling them all the time, so they've got to weed through that as well. And the easiest way to get you on the top of that is to show them that you're credible, and that you can actually close. Now, easier said than done, right? If you haven't closed a deal, how do you do that? Well, it goes back to the other thing. You find an investor that has done it and has done it several times and has a good track record, and then you bring value to them. What that value is, it depends on what you're good at, and kind of need to determine that. What value can you bring another investor? Well, let's say someone like myself, I'm looking to scale. I'm looking to take down more units. I can only find so many myself. So value would be somebody that can evaluate deals and bring in good deals that are worth looking at.
Yeah, exactly. And I think any investor would agree with that, right? That's what everyone's looking for. I mean, the lowest hanging fruit to bringing value to someone who's already done what you're looking to do is bring them deals. Because usually the folks that are in the position you're in, right, where you have, 1,000+ doors on the GP side, and you got a construction business, you've got a capital network, you have experience, like the only missing piece is deals. So it's like, it's just become good at finding deals, or at least building relationships with the people that can bring them. And I would guess, right, that you would agree with this, where a high value or a high use of your time is looking at deals, and just, if someone can just send you deals, granted, the caveat is that obviously they have to just be worth looking at, but like, you're going to get someone's attention if you can do that, especially if it's deals they haven't seen or looked at or know about. So would you say that let's say in the large multifamily business, 100+ units, a good way to do that is, do you still think cold calling is a good way to get in touch with owners and maybe, generate some leads for someone like in your position?
Yeah, absolutely, man.
Yeah, absolutely. And I think it's tough because so many people don't want to do it, right? But it does get results, because getting on the phone is much more important than, sending a piece of mail or sending someone an email or anything like that. So you mentioned right now you own property in various markets within Texas. You own some property in Oklahoma. Are those the only markets you're looking in now, or are you considering looking in other markets as you try to scale?
I would definitely consider other markets. Those are still the two that in-house we're mainly focusing on. But if somebody else was to bring me a deal in North Florida or Georgia or any of those states that are landlord friendly and have shown good growth, then yeah, we'll definitely consider it.
And when you're doing due diligence on a deal that somebody brings you, broker, investor, whoever, And maybe let's assume that it's out of your market. Maybe it's in northern Florida or somewhere in Georgia, or it's just a market that you don't understand too well. What are some of the key pieces within the underwriting process that you're looking at, maybe as it relates to the property itself or the market?
Yeah, no, that's a great question. Because we've had to do that time and time again whenever we're going to go to a new market. One thing, a couple things I know that we do that may be a little different than others is we really want to know about the crime and how bad the crime is in the area. Last thing we want to do, especially when you're going to a market that you don't know, there's always those hidden pockets of, where right down the street it's great, and then you turn the corner and it's mayhem. So we call the police stations, and they're usually pretty helpful. And they give us a lot of detail as far as what they think in the area. And you could look up the crime stats obviously online, but I think it's a little different when you have somebody that's driving the streets constantly, giving you some details. So that's one that we've found pretty helpful. We pull reports from CoStar, and we take a look at the metrics, and we like to look at the population growth, and if you can get good historical data. We like looking at how it fared in the last down cycle, and if it performed well, or at least above average, then that's usually a pretty good sign.
Yeah, I like the tip about calling the police stations, because I don't think I've heard about that, and who better to talk to get the answers on crime, especially at a really local, like street by street level. Because you can look them up online, but it's tough to get it down to like the street and exactly. The neighborhood. You can get them for like the city or maybe like the zip code, but at that level of detail is hard to achieve. So what do you say when you call them? Just like, hey, I'm considering, buying a building on Main Street here. What do you think about the crime in that area? Yeah,
man, that's exactly what we do. We tell them exactly what we're trying to do, and they're always cool about it. I don't know. We've never had somebody say, hey, stop wasting our time or something.
Yeah, they're probably excited that someone cares about what's going on enough to ask about it and hopefully make a difference, right? I would imagine. Right. That's a pretty positive conversation.
Yeah.
And then what about so that's kind of market level. What about the property itself? Is there anything you look for in the actual building or the asset, or the numbers in the deal when you're looking at a new investment?
Building wise, so I'm usually not scared of any of the some people say don't invest on any properties that have flat roofs, or that have aluminum wiring, or there are some things you need to pay attention to that may affect your financing or your insurance. But overall, as far as the property characteristics, I'm not scared of ugly. Just as long as you make sure you have the right people behind you, or the knowledge yourself to where you can estimate what it's going to take to fix whatever that issue is, or to evaluate it. And then, the main thing we're looking for is how we can add value, right? But truly add value. So, just under market rents, I know that's obvious, but
it's the easiest one to see. Adds the most value.
Yeah. I don't want to, I don't know about your market, but here in Dallas, things got so hot that everything was a value add. And we're talking about, you asked a broker, okay, so where are we adding the value here? It's like, oh, well, you put in a fence around this patio and you charge $100 more. Now, okay, is that it? That's the game plan? And yeah, so it was getting pretty bad with the value add stuff. So we look for true value add.
Yeah, exactly. And there's a number of ways to identify that, and it's been talked about a million times. But yeah, obviously, just the lowest hanging fruit, the thing that moves the needle the most is below market rents. And none of this really gets anywhere. Like, you can't really do much if the rents are at market. It has to be a pretty specialized strategy, like something that's really out of the box in order to move the needle on a building's value, if that's already the case.
I'm not saying, sometimes it's there, but definitely harder to find, and a little riskier, in my opinion.
Yeah, exactly. So what are some things, so let's assume you get something on a contract, right? And now you're going to go do your actual due diligence. What are some of the real key things you're looking for when you're doing due diligence, or the things that you're getting from the seller, maybe, or the inspections you're doing that, maybe not that are overlooked by other investors, but are that are really important that you just have to do on all these acquisitions?
Walk every unit. I always say walk every single unit. Sellers are known for, or at least in my experience, for hiding down units, like really bad, gutted type units.
Yeah.
I've caught several where they were straight up just lying. So definitely walk every unit. A unit turn versus a down unit changes your CapEx quite a bit. Check the roofs, no matter what they tell you. Roofs can cost quite a bit as well. If they told you they were put on yesterday, still get someone up there, check them out. Sewer lines, you want to make sure you get them scoped, all of them, and get an idea of what you're working with. You may hear an experienced investor may tell you, well, a lot of the times there's grease in the lines, you can't really tell what's going on unless they're jetted, and obviously you're not going to jet somebody else's sewer lines at that point because you don't own the property. But you should be able to see enough to at least have an idea and put together some type of contingency on what you might be expecting. Let me see what else, man. You got I think I've overlooked. Make sure you get the foundations checked. I think that's more of a Texas, Oklahoma kind of thing, but especially Texas, the soils shifts quite a bit, causes a lot of foundation issues. Drainage can be a big one. That also causes foundation issues if you don't have good drainage, but it could also flood your units. So just make sure it's either the soil is graded away from the property, or that you have proper gutters and downspouts. And if the soil is graded towards the property, that you have drainage set up around, like surface drains and French drains and whatnot.
Yeah, exactly. Taking a look at all the big ticket stuff. Those are three of the most expensive issues you can deal with if there's a problem. And
ACs, sorry.
ACs, yeah, another big ticket one. Heating systems if you're in the Northeast or the Northwest.
Yes. And get a professional to check these out. Don't just put your own eyes on it.
Yeah, exactly. Obviously the key takeaway, right, is you can't trust the seller. Like you're saying, even if he said he replaced the roofs yesterday, you don't know if that's the case, or maybe he did replace them, but he,
hired somebody
who's not great.
Right.
I'm trying to think of the best way to ask this question, but what do you find is, maybe an advantage you have as someone with a construction background? You're running a construction company. You probably understand, just that piece of the business better than most investors do. What would you say are some of your advantages, maybe just experience or knowledge-wise, outside of obviously having the vertical integration of that, but when you're, either doing due diligence or you're actually renovating units, where do you think that you have an advantage based on the fact that you have your own construction?
It allows me to know what the CapEx is going to cost, before, once I do a property tour, and I'm not talking about due diligence, I'm talking about the property tour, and the seller allows me to go in there and take a look. I have a pretty good idea of what the CapEx is going to cost between deferred maintenance and upgrades, and that allows me to make an offer with more confidence. It also allows me not to overpay for something, and get into a property that I shouldn't have because I overlooked whatever it is. And I see a lot of investors that kind of just spitball, $5K per unit. That's what it's going to be for CapEx. But yet there's this major issue that they didn't catch, and that's not going to be good.
Yeah, exactly. Do you have any tips for investors who are, maybe they are the kind of guys that are spitballing 5K unit? Like, is there any tips you have on how they can get a more exact estimate of what it's going to cost to actually renovate all the units and take care of the CapEx stuff? Maybe outside of the units.
I hate saying this, but follow me. I got something coming soon. I've been working on this. I might turn it into an app. Right now it's just a spreadsheet, but it makes it very, very easy for anybody to just plug in unit number, total square footage, and then just answer some questions as far as roofing and whatever, several other questions, and it'll give you a rough number, but educated.
Yeah, and that's a great tool. First of all, I'm definitely going to want to. That's something I can personally use. Is that going to be local to maybe the markets you're investing in, where you have, you understand labor costs, material costs, stuff like that, or is that something maybe someone who's living in Los Angeles could use, in New York City?
Great question. I haven't thought about it that far. I could easily adjust some of the numbers for different markets. But yeah, the prototype will be Texas numbers.
Mm-hmm. Is it, when you're looking at this and, let's say you're walking a 100-unit building, right? And you're looking at the units and you're going to do paint and flooring and, maybe some other miscellaneous upgrades, countertops, stuff like that. Are you typically budgeting or looking at it on like a per square foot basis, or are you looking at it on a per unit basis when you're putting together your CapEx? Or maybe it's neither, but what do you think is a better use when you're actually trying to estimate what something's going to cost as it relates to unit upgrades?
As it relates to unit upgrades?
Yeah, as it relates to, you're in a unit, you're trying to estimate.
Per unit. Yeah, square footage gets a little too tricky.
Okay.
So, it's not going to be exact because of the square footage, but it should come close enough.
Okay. Yeah, the reason I've heard both, right? For, because obviously if you're looking at a property that's all, 2-bedroom, 1,000 square foot units or something like that, it might be different than a building with 2-bedroom, 1,200 square foot units or something like that. Those just random numbers, but, being able to get that down, because obviously the cost is going to be different to renovate each of those units, assuming the business plan is the same. And maybe there isn't enough.
I do split it up into these bedrooms.
Gotcha.
1 bedroom costs something and a 2-bedroom costs something else.
Yeah, and that's when you just your model has to be, you have to be able to break it down enough to actually get to that, because if you're not, you're either over budgeting or under budgeting.
Mm-hmm.
One probably makes it so you're not as competitive when you're offering on deals, and the other means you're getting into a bad deal potentially. So it's important to have that broken down. And so let's talk about the actual executing like a business plan on one of these buildings. Where do you find other investors are maybe not, or maybe dropping the ball when they're actually, buying a property where they're renovating most of the units and turning it around? Where does something typically go wrong in that process, in your experience?
My experience starts from the beginning, and I talk about this a lot, but I get it why investors don't do this, but they don't spend much time finalizing the scope of work before they close. It's usually because they're raising the equity down to like the last second. But if you really try to set some time aside to finalize that scope, decide how you're going to get it done, whether you're going to hire a GC or someone on your team is going to act as a GC, or you're going to have the property, whatever it's going to be, that you get everybody aligned. And we do a pre-construction meeting before we close. So we meet with everybody that's going to be involved. It's usually, my construction company, the project manager that's going to be assigned to that project, the property manager, and the owners. And then we go through the finish outs, the selections, the scope, everybody's on the same page. And then we have an actual schedule of how it's going to get done before we close. So, a lot of work is done beforehand. The second we close, then, it's just, we get to work. A lot of the times what I see is the investors kind of put that off, and then they spend months, after they close, kind of figuring all that out. And a lot of the times they'll ask us out there, and they don't have a scope. They're kind of looking at us to create the scope, which we don't mind, but we should be there earlier. I'm creating the scope, not 2-3 months into the deal. So yeah, I think that could be better. You could start the business plan a lot sooner and get better returns for your investors quicker. And
no, I think that's a great answer, and you have to get ahead of it, right? You have to plan, and I like it's a great tip to get everyone that's going to be involved in the project in the same room and have a cohesive discussion about, this is what we're doing, these are the materials we're using, this is the timeline we're on, because it's hard to have that after you close and your manager is focused on managing the property and assuming that they were going to oversee maybe some of the renovations, right? They're probably going to be more focused with the actual property management and the existing tenant base than trying to work with you on building out that scope of work after you've already closed on the deal.
We want them focusing on the property, on the management of the property, the existing tenants, getting in the new residents, and not so focused on the CapEx part of it.
Exactly. And I think, it's great that you have a unique view too, because you're providing the services to other investors and you're also doing your own deal. So you probably have a firsthand view of what works and what doesn't within that process. Right. And we're hearing it from the horse's mouth right here. It's so much better to have that conversation ahead of time with whoever the GC is going to be, or the construction company, or, the property manager, if they're doing this in-house, because it's just, once you close, there's so many other moving parts that you have to deal with. Mm-hmm. So this has been great. We're coming up on our time here, but I have 3 questions that I'd like to ask you that I've been asking almost every guest. Sure. First one is, what's one thing that you attribute your success to as you've grown your real estate portfolio?
One thing would be having the right mindset. A lot of us we defeat ourselves, and I've been there, and I think to do anything successfully, you've got to get it right up here first, and then go after it. Is
there anything in particular that that's maybe separates what you're talking about maybe from other investors that have either failed to scale as quickly as you have, or failed to get off the ground, or maybe just failed in general?
I don't have a specific, but just having some limited beliefs, maybe thinking that you can't do that. There's no way that you would ever be able to have 10,000 units under management or something like that. Pretty much just defeating yourself and limiting yourself. Whatever, if it's something you really want, then you just need to put the focus towards it and come up with a plan of how to get it.
Yeah, that's a big one, especially as it relates to large multifamily deals, right? There's so many limiting beliefs. Oh, I can't find a good deal or compete with the guys that are doing that, or can't raise the capital, or I can't do it out of state. There's a million.
Those are big ones, by the way. Those
are probably the big ones, right? The big 3. And those are the ones that I deal with, right? But other people have done it, and you listen to enough people do it, you understand that you can do it as well. Second one I got for you here: if you were starting your business over again, knowing what you know now, what would you do differently, if anything?
Yeah, it's an easy one. Start investing in multifamily first.
Yeah. It's a pretty common one, yeah. I had someone say be born 10 years earlier so I could start investing in 2011, and I thought that was a good one too.
Yeah, that's a pretty good one.
But yeah, I mean, especially I hear that a lot with people that are buying cash flowing assets, whether it's multifamily or not multifamily. It's like just buy them earlier because that's going to build a better financial foundation than the transactional business. And you
to throw another angle out there is even investing passively earlier would have been great.
That's interesting. I haven't heard that one before. Is that more of a financial decision or more understanding the business from that
financial?
side?
Financial.
Yeah. I think that's a good one. Yeah. Especially probably if you're looking to be a GP as well, because it's almost education at the same time. You're understanding how the
I invested passively in some deals before I got on the GP side, and that was more. I mean, it was great for the returns and everything, but it was also to learn at the same time. But yeah, I mean, the tax savings, I mean, all the stuff I could have done that I wasn't doing, years before that.
Mm-hmm. All right, last one before I let you go here. What are you looking to do in your business over the next 6 to 12 months in terms of maybe what you're looking to buy in which markets? I mean, we already talked about that, but just in case someone's listening who wants to connect with you and can maybe offer some value.
6 to 12 months. I mean, we definitely plan on closing on probably two deals, maybe 3 deals. We think that's 6 to 12 month mark. We're probably going to start seeing some pretty good opportunities pop up. A lot of questions still out there with COVID and what's going to happen next. How are we going to open everything back up and at what speed? But we do feel it's a ripple effect. Some of the things that have already happened, and we're just gearing up to be ready to take down some more properties. We've got a great looking one right now that has just fared amazingly through this whole pandemic. I mean, I know obviously a lot of the collections have not been nearly as bad as people thought that it was going to be. Whether that was a stimulus, and I mean, I'm sure some of it was for sure. Just looking, we've been looking for specific markets that are performing even above that average. Taking down some more deals, man.
Yeah, no, 6 to 12 months. I mean, that's the timeline of what a lot are predicting to be some distress, at least on the sell side, especially as a lot of the stimulus does run out. And, we're recording this on July 28th, I think it is.
Yep.
Losing my mind. All the days blend together here when you're stuck inside. But so we're recording this on July 28th. Yet to see how the stimulus gets extended. At what amounts. I mean, that's still being decided upon by the House and the Senate, everything like that. But long way of saying that's probably going to have a significant ripple effect into tenants' ability to pay, especially in B and C class properties, and that's going to change the market in the next 6 to 12 months. So stuff we already know, but hopefully there are some buying opportunities for the folks that are looking to buy and have capital ready. But hey, look, this has been a great conversation. I think there's a lot of actionable tips in here for the listeners to take away and implement in their own business as it relates to due diligence and finding deals. I know I'm going to start calling police stations when I'm not sure of an area. That's a great tip. If folks want to connect with you, where can they do so?
They can get basic information. I've got some free ebooks on my website, which is elevatecig.com. It's a commercial investment group, so elevatecig.com. If they want, they can also shoot me an email at Jorge, Jorge, at elevatecig.com, and I can send them. I've got a due diligence checklist, questions to ask a sponsor before investing, and a couple other free content.
Awesome, man. Well, this has been a great episode. I really appreciate your time. Thanks again.
Thank you, man. Appreciate it.